Are we going to see more of this emerging market contagion spread to other markets? Are we going to see the sell-off continue? And what can stem the flow?
Well, what's happening in the emerging market is that U.S. policies, Fed raising rates, and the fiscal stimulus is implying higher short rates, higher long rates, stronger dollar, lower dollar price of commodities, and now you have the risk of trade wars. All those four factors are negative for emerging markets, so you have seen a sell-off. But of course, market discriminate between better and worse credits, and among emerging markets, those have been hit the most are those that have macroeconomic, domestic, and external imbalances, countries like Turkey and Argentina, but of course there is risk also in Brazil, in South Africa, in India, potentially in Mexico, and so on. What has happened is there has been contagion because crossover investors have moved out of emerging markets. Those are tourist investors, and now even some of the dedicated investors have suffered such large losses. It's a better market in EM equities. They're also selling off the better credits. And in my view, things are going to get worse for emerging markets before things stabilize. Things are cheaper, but they're maybe not cheap enough.
Okay, so how much more of a correction can we expect? Is it a 10% fall, 15, even 20?
Well, on one side, the factors are driving all emerging markets, like U.S. policies are going to continue. That's a negative. On the other side, I would say that we'll have to see the policy responses of individual countries. Turkey, for example, they'll have regional election in March. They have to do monetary credit and fiscal adjustment. They haven't done it so, and are not likely to do it because of the political constraints, while Argentina has been recently in trouble, but at least they have a fiscal and monetary program that over time, if implemented with the IMF program, may lead to a stabilization. So I think that markets are going to react to each country individually depending on their policies, but then there is this broader global factors that is driven by U.S. policy. It's going to be a pressure downwards on EM.
How much do you worry about the trade war escalating between the U.S. and China?
I do worry because this is not just about trade. I think that the new national security strategy of the U.S. is that China is being a rival that has to be contained on trade, on technology, on the industries of the future, on IP, on joint ventures, on technological transfers. And therefore, in my view, this is something broader. It's going to be long-term. It's not going to be just about trading goods or the trading balance. And the U.S. has decided to essentially challenge the rise of China. And therefore, this conflict is going to become much worse over time.
Okay, what does that mean for Federal Reserve policy? Do they need to stay put? Because, of course, if they hike more, dollar goes up, and this impacts the emerging markets right at a time when we have this trade war escalating.
Well, the response of the Fed to trade war is ambiguous because the trade war is a stagflationary shock that at the same time increases inflation, reduces output. If it reduces output growth, they should be stopping or gradually rising rates more slowly. But if inflation goes higher, then they should be tightening faster and sooner. I think that the reaction on the Fed depends on what happens to inflation expectation. If inflation expectation remain anchored and you have only price level effect coming from the trade war, they can essentially look through it and ignore it. If instead there will be an increase in inflation expectation, then they have to tighten more and faster.
But when do you expect emerging markets to stabilize? Is it 6 months, or again, is it depending on what each country does in the next couple of quarters?
Well, I think the investors are going to be discriminating on one side by selecting different credits and looking at the individual policies. But as I pointed out, what the U.S. is doing is imply that, however, gradually interest rates in the U.S. on the short and long end go higher, the dollar goes higher, the trade risks are there, and they're going to intensify. And therefore, those are going to be putting downward pressures across the board on EM, at least for another 6 to 12 months.
Do you worry about the Italian economy? Do you worry about what the government could put in place with the budget law and the impact this could have on Europe as a whole?
Yes, this new government promised the moon, essentially 6% of GDP fiscal stimulus. But now, as we've seen the last weeks, when the spreads on Italian relative to bonds went above 300, they panicked and they said, we didn't even mean when we said we wanted to breach the 3% deficit, we want to keep it close to what was. We're not going to have a confrontation with the markets and with Europe. But they have essentially a problem. On one side, they promise a lot and they have to deliver it on the base. On the other side, there is the market constraint. I think that eventually the market is going to put pressure on them, and they're not going to increase the deficit relative to this year as a share of GDP. That may be semi-acceptable to the EU, maybe semi-acceptable to the market. If instead they try to push it even towards 2% or 3% of GDP, then you'll have a real problem.
Okay, but so are you telling me that you're actually expecting spreads between the Italian and German 10-year, for example, to widen before it gets better?
It depends very much on what's going to be the budget they propose. If they propose a budget that has a deficit close to the one of this year, then, and they don't have a confrontation with Europe, spreads are already high at 250. They're going to stay in that range. If instead there is even a sense that you're going to have a fight with Europe, they might go to new elections, then there is a confrontation with the markets, then spreads can go above 300 again.
Is that 2.5%? Is that, what's the limit, basically, of the percentage to deficits that will freak out the market?
I would say if the deficit were to go significantly above 2% of GDP, then the markets are going to get very nervous, because at that point this is a deficit not acceptable to the EU.
Very quickly, where do you see euro?
Well, the euro depends very much on what happens also to the dollar. On one side, the fundamental of the U.S. would suggest that the dollar should be becoming stronger, and the European economy has been somehow softer. The Fed keeps on hiking, but the signals from Jackson Hole have been that Powell has been perceived as being slightly dovish. That might put an upward limit to the upward pressure on the dollar, and therefore there could be a stabilization in the euro relative to the U.S. dollar in the next few months.